Welcome back to the Owner Seat Podcast, where operators get the real truth about what's coming next and what it means for growth, margins, and survival. Today's episode is about franchisees, franchisors, and business owners thinking about a sale or even just wanting to build a business that's sellable on command. Because here's what no one tells you. When private equity shows up to the door, the game becomes financial evidence, not vibes or how you're feeling emotionally. The buyer isn't paying for your story. They're paying for financial proof. My guest is Michael Iannuzzi, partner and franchise practice leader at Citrin Cooperman. You've probably heard of them, and they've probably been in your financials. Michael works with franchisors and multi-unit franchisees across industries, including fitness, QSR, and more, and advises on franchise-specific issues like the good old FDD, financial narrative and pitch presentations, franchise performance representations, advertising fund structures, restructuring, and asset protection. Today, we're breaking down in operator form, as we always do on the Owner Seat Podcast. We're going to talk about Q of E. What the heck is that, Albert? It's quality of earnings and what it really is and how it determines and can decide your valuation. What private equity and diligence teams look for first, how add-backs and the add-back activity works, and how it can beef up your adjusted EBITDA, what your financial data room needs to look like even before you decide to start pitching, raising, or selling, how to prepare now so you don't get crushed on working capital, normalized earnings, or any type of surprise adjustments that's going to give you a haircut on that sales price. And finally, franchise-specific landmine that kill deals and how to fix them early. Michael, I know that was a mouthful. I'm so excited. This is so important. So important. Welcome to the Owner Seat Podcast, sir.
Yeah, Albert, thank you so much for having me. And I'll say the power of networking, right? You and I connected on LinkedIn. We exchanged a couple of messages. We had an intro call, and here we are talking franchising, private equity, and all the fun stuff. So
this is the fun stuff. My pleasure. This is talking shop. And here's the thing. There's a lot of franchisors, as I mentioned, franchisees, business owners, and entrepreneurs in the wellness, the fitness space. We have some active finance leaders on here. This is going to be a gem and a treat. This is where y'all listening and watching, as you're working out, just take mental notes, transcribe it if you need to, take notes, because this is the thing that's going to allow you to run not only a great business, but if you're thinking exit strategy, you got to hear from Michael. This is what they do all day. And Mike, so, I hear this a lot from owners. I want to sell in the next 12 to 24 months. What do you find as you start to talk to these owners and you lift up the hood to their financials? What's the first hard truth they need to hear?
Great question. And the first hard truth is they have to be ready and they have to be prepared, and you have to know your numbers. 12 months to 24 months is probably aggressive. Like if you're saying right now, I want to sell within the next 12 to 24 months, you got a lot of work for you to get ready because you're running a business. You have your finance team doing what they're doing. When you prepare for a transaction, it's like having a second job. Like it totally consumes you. It takes your life over. You're on calls all day. Requests are coming in from investment bankers, people like you, Albert, people like us, lawyers, the franchisor, if they're getting involved for right of first refusal discussions, like it consumes you. And so you need to be ready and you need to prepare as early as possible. And that means from today, even if you're a year out, 3 years out, get your house in order financially, operationally, legally, and prepare from now as if you were going to sell, regardless if you're thinking about it or not. Get ready today.
That's so good. And we're hearing a lot. I had Pete Moore from Integrity Squares on the show. He does Halo Talks and the Halo Academy, very active in the space. I'd imagine he works with Citrin or some others and banks, investment bankers as well, and private equity. And what we're hearing is the cycle's coming again. We're seeing this major cycle. EOS is a great example here recently, but we're starting to see the consolidation. We're starting to see the roll-ups. And so some of the videos that I put out there and some of the conversations that I've had on here is private equity's coming to your backyard. What are you going to do? Are you going to try to defend against, which is very hard when they start to surround you with competitors? Or are you going to try to get your unit economics discipline? Are you going to try to get that financial back office and data room sound, as you mentioned, getting ready today so that 2-3 years from now, you're ready to rock and aren't hearing the terms haircut. You don't want a haircut on your sales price.
Absolutely
and a lot of private equity, they're actually, from what you've seen, actually, I'd love to ask you this. What are they rewarding right now, or maybe even recent past when it comes to franchising? Is it revenue growth? Is it margin stability? Is it what I like to talk about, unit economics?
Yeah.
Or is it the clean reporting? Maybe all of the above. I don't know. What are you seeing?
That's where the highest trades are going to take place, when it is all the above. Look, strong
Mm,
management team, but at the end of the day, unit economics and sales and profitability, that cures a lot of issues, not all of
hmm.
them, but it
Yeah.
does cure a lot. And franchising, franchisor, franchisee, you will hear it forever. It is about the franchisees. The franchisees need to make money. That means your unit economics need to
Hmm.
be strong, and that is what's going to attract the private equity buyers, and that's what's going to get you the highest multiple at the end of the day. But all of these things have to work in unison. So, you're
Yeah.
talking
That's a good
fitness
point.
here. Take all the large multi-unit franchisees. These people have 30, 40, 80, 100 locations. That's
Right.
100 leases. That's 100 utility bills. That's maybe 100 payroll runs, depending on how you structurally have your company set up. Like, you need to have that in order, because when
Yeah.
they want to start reviewing the leases and these favorable terms, unfavorable terms, what's the next escalation in the lease? And you have no idea what's going on. Even if your unit economics are good, people are going to kind of ride you on that. And they're going to say,
Hmm.
well, we have work to do. So we can't pay you 10 times. We're only going to pay you 8 times, because there's other 2 times we have to invest to get you up to where you need to be.
Yeah, that's so good. And where I see a lot of the issues, even when it comes to like messy financials, to your
Yeah.
point, inconsistencies across KPIs, and the other thing, speaking of franchisors, and I won't mention any names, but you know, one of the biggest things that I see from some of these large, well-known brands is the franchisees are all on different ERPs. And
Yeah.
so as you're trying to aggregate all of this data and consolidate from each one of your units, very difficult to do, and it's coming in different forms. Now AI is somewhat solving for that, not all the way there yet. And there
Yeah.
are aggregators you can integrate, but that's huge when someone's coming in and lift up the hood. And sometimes I'm sent in. I work with private equity pre-acquisition, and I get
Yep.
sent in, and that's how I like to treat a lot of my clients. Like, I'm gonna show you what it means, due diligence, and I look for those things, some of those inconsistencies. Is like once I see something, one thing inconsistent, I'm like, I don't trust this. So now I'm gonna look even further, and that's what a lot
Sure.
of the private equity teams do.
Yeah, and especially at the franchisee level, like, unlike a franchisor, where franchisors have to be audited, they have to have
Right,
gap statements, to kind of building on your point here. Franchisees don't have to do that
right,
until it's required. They could be cash basis, tax basis, accrual basis. They can be on all these different methods. So, when they're getting gearing up for this stuff, people like you are converting them from cash to gap
right.
or to accrual, getting them audited when they've never been audited. And it's like, there's a lot here at the franchisee side that's very different from the franchisor, because of rules and regulations.
Right.
Franchisees don't have to do this stuff unless somebody's asking them for an audit, or asking them for a gap financial statement, or certain consistencies that you're finding that don't exist because they're not required to do it.
So, and what I find too, and obviously people watching this are probably following me on LinkedIn, so they see some of the educational output. But there's obviously a ton of people, and that makes it exciting for me because there's so many more people that just need that financial literacy and
Yeah.
education. But that's typically where it lands. Is just people just don't know what they don't know, right? How did you learn? Was it through your education background? Was it certain mentors and books? Like, how can these owners learn more and educate themselves so that they start learning about it, what a QAB is, or
Yeah.
what even, like, we might have lost some people when we talk about cash gap and
Yeah.
accrual,
Yeah.
right? How did you learn all of these things, and what would you recommend to the audience?
Yeah, so I'm a CPA by trade. So obviously we had our own technical training, continuing
Hmm.
education, things like that go on, within a CPA firm and a professional services firm. I had lots of mentors over time as I really got involved in franchising. My partner Aaron, that had founded the franchise practice, he kind of mentored me for the last 20 years.
Amazing.
He's my work dad. But then I got very, very involved in the conferences, right? So
Mm,
between the International Franchise Association, multi-unit
that's a good one.
convention, and all these others,
Yeah.
there's a ton of available education to everybody. And look, you go to these conferences to network and meet people. I also go to get educated, and I want to hear what's going on. I want to hear from the panel. speakers. A lot of these have private equity sessions and private
Hmm.
equity roundtables. They're all talking about these types of things. There's conferences just kind of on private equity transactions. So if you really want to get educated, number one, you can do a lot of the industry stuff that's out there. And then your professionals, if they're very active in franchising, they could be educating along the way too, like teaching you, guiding you, coaching you on kind of what's coming down the pipeline when you're
Hmm.
having these types of strategic, I would call it 2 to 3 year out discussions.
I love that. Yeah, there is a lot of conferences, and I'm hoping, and I'm starting to see it actually in the fitness and wellness space. Some of these
Yeah.
fitness and wellness conferences starting to layer into your point, private equity roundtables, or maybe they call it investor roundtables.
Yeah.
And I'm hoping to see more for those that maybe you're, and I'm saying these names because I really love them, Beyond Active or HFA. We start to see more panels around this. They're starting to
Yeah.
do that, which I'm really excited about because a lot of these business owners need that. It's not just the, how are we doing in operations and what's new in AI, which tends to be the hot one right now, or what are we doing in marketing? How about your finance back office and what's really going to lead to maybe even a solid valuation if all looks right? And speaking of that valuation, there's just so much to teach there because a
Yeah.
lot of the times when I jump in, again, going back to financial literacy, a lot of these owners get very married to their P&L and L and their revenue. And there's just so much more as we think about flow through and unit economics and the yield play
The
down to
balance
your
sheet.
EBITDA, the balance sheet. So what's Citrin Cooperman, or maybe what's your approach, Michael, around valuation? What are you looking at? And is it on a case by case basis or industry by industry? How do you look at that when you're looking at a franchise model?
Yeah. So, we use specific tools that are out there. And you mentioned it in the intro, the quality of earnings report. That
Yes.
is, that is super popular,
Yeah.
especially
Y'all are
in,
thorough, by the way. I've
yeah.
worked with I've worked with Citrin Cooper even recently. Very thorough. You
Well,
put me to work.
thank you
You
for
put me
that.
to work.
Thank you for that. The quality of earnings report is, a very popular tool that people have been using for a number of years. This gets you really like kind of to what the business is kind of running at. So in the quality of earnings report, we mentioned all these bases of accounting before, cash, gap, all this stuff. So if you're a sophisticated franchisor and you happen to have gap financials, audited financials, you're probably sitting here going, well, why do I need a QV? Well,
Mm,
the buyers almost always require quality of earnings. And the reason why they're requiring it is because they want to understand kind of what the future and current run rate of the business is outside of gap. So a very simple example is you have gap profit, let's say of $1 million, and your adjusted EBITDA on a QV could be 2 million. Well, why
mm-hmm.
is it different? The reason why it's different is because gap is what just happened. This is what happened, my 12-month
Right.
period. These are my expenses. That's what happened. But there may be things in there that are non-recurring, one
Mm,
time. Maybe you had a litigation case you had to pay out, something like that. That impact your earnings, but it's not going to recur next year. So we do these exercises, and then now we're going to say, well, we need to give you credit for that charge because that charge will not exist in the future. So we're going to add that back to your gap
yes.
revenue. Now the EBITDA jumps up. Can go the other way. Owners start saying, "Oh, I'm not going to take compensation. I'm going to make the P&L look really good, and my EBITDA is going to rise." Okay, well now if we sell, we need a CEO or a CFO.
Mm-hmm.
Well, realistically, you got to put those expenses back in because yes, you as the owner didn't take it, but we need a CEO to run the business when we buy it. So now
Right.
we're gonna go the other way and we're gonna layer in some expenses, and now we're gonna move your EBITDA back down. So very important to understand how these work. Those are very basic examples of what goes into it, but those are really the tools that are looked at both on the buy side, sell side in private equity transactions.
So a couple things for those listening, and I'd recommend there's great YouTube videos.
Yeah,
Michael, we'll get to your information and how people can reach out to you, but quality of earnings, you'll see that, especially as you start getting very involved in some type of exit strategy, or you're really thinking about it, you want to learn more quality of earnings or Q of
yeah,
E. And then Michael just talked about an add back strategy. And I remember back in the day when I learned about this, I'm like, wait a second, you're removing expenses, but you're not adding it in. You're adding it back to your EBITDA, right? Let's call it just EBITDA
yep,
for this example,
yep,
right? Which is coming up to what Michael's talking about, the adjusted EBITDA. You're adding back those, maybe it's discretionary spend or you need some normalization going on or
yep,
some type of one-time expense that typically just would not occur. And so I love doing this activity. I did it recently with Citrin. I do it myself with some other clients because if you're trying to look at what is a true EBITDA, what is this business truly going to make, even post acquisition, you want to get to that number, which obviously impacts your
Yeah.
valuation. Is there anything else, at least in the franchise world, that
Yeah.
you see are the most common, maybe common things that you would add back to?
So if it's okay, I'd like to give kind of an expanded
Yes,
example of what else is
please.
in the QVs. Again, larger multi-unit franchisees that have development schedules and development cycle they have to meet. Say at the time that they're preparing, they have 25 units open, but their development schedule says, well, you have to have 40,
Mhm.
by X date. So part of this process is, okay, well, if we assume we get them all open, over the development schedule, what credit are we going to take for those units?
Mhm.
So there's certain calculations, forma adjustments that go into the QV that kind of give certain credit to the units that are being developed over time.
It's
So
like a
that's
ramp
a
bridge.
very
It's a ramp.
Yeah, ramp up. That's a very big
Yeah.
franchise one. Both sides, the franchisor sold but unopened units, and what's the timing of getting those open and credit for the
Mhm.
royalty stream. And on the franchisee side, committed to and undeveloped or unopened units. What does that look like when we kind of say, okay, in 3 years, all 40 are open? If we all have some sort of blended run rate, what does that look like as a whole on
Right.
this population of units? So these are like kind of the big things that get looked at on a QOE.
And that is so important because when I lift up the hood, typically that pipeline schedule is typically not well thought out. And sometimes it's only because we think about just the sales side of it. And it's like, all right, we signed the deals, we're good to
Yeah,
go. But as you'll go through this during the QV and what Michael's talking about, exactly what you said is that ramp or that bridge,
yeah,
right? Which is actually providing you more value when you think about your sales price because there's value in your pipeline. But you have to know, and we won't get into the details of snow, and maybe we will actually, what's signed, what's not open, right? What are we working on? So snow, you'll want to look that up too, grab a YouTube video or keep watching these podcasts. We'll go through that. But you want to understand that pipeline because there is value there. To Michael's point, you should be getting credit for that in your sales price because that is value of your business. Those things will be open or should be, but you got to
yeah,
know. Because one thing I'll tell you, when I do my due diligence, if you tell me something's going to open and I find out or I go in and I'm doing my research and I realize, wait a second, out of these 40, you're really only going to be open 10. Like I'm not giving you credit for
yeah.
40. That's a
Correct,
discount. That's a
correct.
haircut. So you have to be on point and you got to be precise too. Cause again, time and inconsistency kills deals
Oh yeah,
or you lose money, meaning you lose money off your sales price. So it's so
yeah,
important to follow what Michael's talking about here around Q of E, invest in it. So important. And it's that stamp of approval. You see Citrin on anything, it's gold, right? It's a gold stamp. It's true. And the add back strategy, as well as that ramp bridge, you have to be on point and get it done today versus waiting for the future and down the road when it's too late.
And this
So
is why having your internal systems and
that's
controls and
right. Yeah.
policies and procedures is super important. Like we're not saying the owners of these businesses have to be accountants, but you have to have the operational financial mind to understand what's going on at these units for exactly that description you just gave. We got 20 open, we got 10 to go. What does this look like? Well, you need the systems in place to be able to have that data so we can make assumptions to project out for the next 10. Like very, very important.
Yeah. So aside from, because I really want to double click on the valuation piece, and I have gotten feedback that on these shows, there's a lot of education, but it's Albert, give us some, like, what can I do today? And Michael, so I wanted to ask you this around valuation. What are some of the things that owners that are listening and watching this can do today to impact their valuation? And then the second question to that is this term multiple comes up a lot.
Mm.
How do I determine the multiple that I can use to create some type of sales price for my business that I want to sell maybe in the next 2, 3, 4 years?
Got it. Got it. Okay. So yeah, so some general stuff on the valuation is building on the things we've been talking about, like get your data room in place now. Make
Mm,
sure you have all your legal documents in place. Make sure you have some of your financial controls in place that the numbers, like not just some random QuickBooks files. Like you have to kind of know, what's going on. Build the room from now, have it organized. Don't have franchise agreements that you thought you executed and you never signed.
Mm,
Don't have missing addendums to your development schedule that, the one you have signed says it's this term, but the one that was an addendum said, well, you have this much more time to get those units, because multi-unit deals, those get amended all the time. So make sure you have all these documents in place. That will give the buyer confidence that what you're giving them, helps. And what's the second part of the question?
Second part of the question just was around the
Oh,
multiple
multiple.
pieces.
Yeah, yeah,
Yeah,
yeah.
it's like how do you determine that? Is that on a comparison on comp perspective, or
Yeah.
is it industry by industry, or can it actually be business by business depending on what the business model is within the industry? How do you determine what the multiple is?
Yeah. So this is when you have really good investment bankers in place. They kind of know what the industry benchmarks and the industry
Hmm.
standards are. Franchising historically has traded higher, than non-franchised businesses. I mean, that's not the said rule, but it does happen, more
Hmm.
often than not. But overall, in terms of the multiple, there's a ton of industry benchmarking and scenarios that are out there. And in the fitness world, like there's so much private equity in large multi-unit fitness franchisees that the
Right.
data on these multiples are out there almost by brand. And I don't want to mention brand names here, but there are certain brands who have rolled up over time. Franchisees are rolling up. There's a lot of private equity throughout the entire system. Well, all
Yeah.
those deals have traded. So there's industry resources where you can go see what these trades have taken place for, to kind of give yourself a benchmark of where yours would go for if you had similar metrics as the ones that already completed.
Right. And I like to get in trouble, so I'm gonna say I like, and I
I'll
work
leave
out
that
of
to
all
you.
these. I love all these brands like Planet and Orange Theory and Perspire Sauna Studio and
Yeah.
all of these. So yeah, you're right. Go check them out. And the cool part too is, and a lot of people don't know this is, and we'll get to the FDD here in a sec, but it's public. So you could actually learn about these, and you should if you're even thinking about being a franchisee. And you typically learn this through the process as you're becoming a franchisee is you want to look at this public data, their P&L, their
Yeah.
balance sheet, their cash flows. You're calling all the franchisees to get kind of the inside scoop, right? And there's
Oh,
always
if
a
you're just
mixed
getting
bag.
into franchising as a Z, absolutely, you better be going through that FDD and calling the Z's for
Yeah.
sure.
So let's talk about that, because even recently there's been some brands out there, some big name brands, publicly traded brands where you might have been squeezing a little bit of out of that item 19. So where do people get in trouble? Let's talk to the franchisors that are watching this and listening. Where do they have to get it right on their FDD, or there's going to be potentially some red flags? What do you see there?
Yeah, I mean, look, the FDD is a legal document, governed by the Federal Trade Commission, and then the
Hmm.
14 or 15 registration states that are out there that have their own set of rules. Look, people do use the FDD as a sales tool. I also believe you should be using the FDD to be transparent.
Hmm.
So when you get to certain schedules in the FDD, let's call it like the item 7,
Right.
estimated initial investment. Well, that's a very broad range depending on where you operate. Like I'm in New
Right.
York, so to open a gym in New York is going to cost a lot more than it to open in Nebraska. So like, are those ranges that you're disclosing, the high end and the low end, do they fit kind of everywhere where you think your market is going to go? Like, so these are tables with published numbers in there. So you want to do your research before you publish it. 19, very, very popular. Years ago, there weren't a lot of items disclosures. That's kind of gotten very popular. I would say over these
Right.
last 7 to 8 years, you see a lot of item 19 disclosure in there. Follow the legal rules around the item 19 and make it so people understand what's going on. Like, yeah,
Hmm.
gross sales is important, but what about average ticket volume, or, average ticket price? Or if I'm a barbershop, like how many chairs are in the barbershop? How quickly do I turn each chair for a haircut so I can figure out my employee count and how much payroll I need to run the place? Average membership on the fitness end. If I have tiered membership, what's my population of tiers? How many people are on the top tier and middle tier? Like, kind of give like good, real information.
Yeah.
And the important thing is you have to have that information. So
You're right.
you can't just publish the FDD and 4 months
That's
later
key.
accumulate it. And no, if a regulator asks you for the backup, you have
The
to have
tie. Yep.
like you have
It
to
needs to
populate it
tie.
before. Yes.
So for those you rewind this part because this is so key because I see this a lot, especially when I lift up the hood and obviously I'm going in for a reason, but then I see, hey, our item 19, this is what it is. Great. Give me the tie back. I want to see the audit trail, how you came up with this exact
Yeah.
number. And sometimes that's difficult. I'm like, oh no,
Yeah.
like we're gonna get torched. But that's okay, that's job security. All right, let's go do it. Let's go do it. Or I'm calling Michael. Look, Michael, help. So that is so important, Michael. What you just mentioned there is not just about the transparency, the compliance, and all of that, but for the due diligence piece, you have to have it tying back to the actual data,
Yeah.
right? It really, you should be working backwards, actually. You should be using all of that data and consolidating it up to your item 19, and there you go. There's your sample size, right? But still to this day,
Yeah.
some large name brands, or maybe they're up and coming, they just don't get that right. And it just creates a lot more work and scramble and headaches and anxiety, to be honest,
Yeah. And I
to
think part
try
of
to
it's the
find all that.
systems, like
Yeah,
if you have all the franchisees linked up, and this again, this is at the franchisor level, and you have
right.
good data coming in, not just a gross sales where you're calculating the royalty and the brand fund, but you can kind of benchmark the system and give feedback to the franchisees on,
Hmm.
how their region is doing versus their competitors. When you have all that running, the item 19 then is much easier to populate because you have the data that you can pull. And now you just have to make sure you're doing it within the legal framework of the item 19. But
Yeah.
when you're just kind of grasping at straws or you don't have these systems in place, it's very difficult to populate those tables.
So before we get into the financial data room, can you walk us through a little bit more? And sorry, I'd even tee this up in the beginning, but just about Citrin Cooperman. For those that haven't heard of Citrin Cooperman, can you walk through everything that you all do, how it came about and become what it is today? I mean, it's a behemoth. And I was mentioning, and seriously, for those listening, I've worked with Citrin and they're very, very thorough, highly respected organization. I don't even know how Michael's on here. This is awesome. I'm very lucky. So thank you for your time, sir.
No,
But
thank you for having me
do
again.
you mind walking through everything that you all do? Because you have a very robust ecosystem.
Yeah, no, sure. So, yeah, Citrin Cooperman is now considered a professional services firm. We have offices throughout the country, and we are, we perform all the normal compliance work that any, kind of typical CPA firm would, audit, tax, consulting. But we've also built this ecosystem of advisory services, which are the things we're talking about now. Valuation,
Hmm.
quality of earnings. We can upgrade ERP systems. We can do litigation support, for testimony, damage calculations,
Wow.
outsource CFO. We can run your entire accounting department, software automation, dashboarding tools, things like that. And so the firm has grown through lots of acquisition. So the things we're talking about now is kind of how the firm grew. We've acquired professional services firms and CPA firms over time. And we're kind of broken out by industry. So I'm the franchise practice leader. And then we have medical, dental, real estate, construction, restaurants, just to name a few. And those verticals all have teams around them that
Hmm.
fit each of the buckets of the services that we're talking about. So I have a dedicated franchise team. I have a bunch of CFEs, certified franchise executives that are on my team. I have a really great team of people. Some of these people have been with me for 15 years, since I'm here 20. So they're with me since they started.
Wow.
And these are really good professionals. You'll see a lot of them out at the franchise conferences. They travel around with me as well. And it's been a really good run. We're very proud of what we've done. We have great client support, great prospect support, and we just try to add value wherever possible by making intros, educating people, speaking at conferences, doing roundtables. So it's been a
So
good
good.
ride. It's a lot of fun.
So good. Thank you for sharing that. And a couple things that I picked up too that I didn't realize. And I'd love to chat about it if you don't mind, but actually I lied. We're not going to get into the data room just yet. I got a couple
Okay.
more questions. But you talked about data migration,
Uh,
tech stack modernization is like a big thing right now, right? Obviously, a couple years ago, I think 3 years now, it feels like it's 10 years ago, but 3 years ago, OpenAI decides to launch what is now ChatGPT, and now you have Copilot, all of these things. And we're starting to see a lot more adoption within the finance back office, the finance tech stack. And so, how do you guys approach that? Is there different partnerships that you look for or have as you're kind of dissecting what the organization looks like? I'm sure many listening and watching, they're thinking about, shoot, I need to do something. Maybe it's a franchise or just a business owner, maybe not
yeah.
necessarily a franchisee, because typically you're kind of following the franchisor in most cases with that. But maybe a business owner, entrepreneur in the fitness wellness space that is looking to just get faster data. You mentioned KPI dashboarding.
Yep.
Still to this day, there are people reaching out to me. Can you build this? Can you use Power BI? I'm a big fan of Domo, although a little pricey, y'all, but I like Domo,
Yep.
right? Power BI and some others, Google Studio or what have you. So you all are doing this work. That's
Correct.
amazing. What are you
Yeah.
seeing as the biggest opportunity, or what's the biggest trend going on right now?
Yeah. So the data is definitely it. So for the larger, franchisors and franchisees that are out there, we have vendor relationships with certain software providers where we'll do the implementation and setup of it for you. So you're getting our technical digital people layered in with our franchise practice.
Amazing.
So we kind of know how to, tool the software to your
Hmm.
needs as a franchisor or franchisee. So we have relationships with Vena. Vena is a very
Yeah,
powerful FP&A tool, dashboarding, cash flow, projection reporting tool. A lot of
amazing.
people really like that. A lot of people in franchising also have a relationship with Workiva, where we'll do the implementation of Workiva. That's a pure like financial statement
Hmm.
reporting tool, and that's for people maybe thinking about going public or on the next private equity turn, and they really want
Right.
to get that like internal reporting and external reporting to the investors and the PE group kind of solidified. So we have relationships with other providers as well, where we are the implementers, and based on the industry that we're implementing, somebody from that industry will be part of that team to make sure it's getting implemented to fit the industry that we're plugging into.
That's huge because sometimes you'll get, hey, we're going to do this internally. And if you don't know anything about API integrations, coding, or how to even migrate,
Yeah.
I've seen it even happen with desktop to online and
Yep.
QBO. It's a beast. So highly recommend that you're raising your hand asking for help. And of course, modernizing with the times because business nowadays is so much
Yes.
faster.
Yeah.
And people are expecting, not only your internal team members are expecting faster data to do their jobs better, but so are your customers, or in our world, fitness and wellness members are expecting things to be fast
Yeah.
as well. So
And when you
important that you're
And when you're PE backed, how great is it if you go to the table saying, "Oh, these are the reports you'll get automatically every month. You don't have to ask for it. You don't have to request it. We give you a login. That's what you see, PE firm. You don't need us to email anything to you. We've already set this up for you in
yeah.
anticipation of a transaction." That gives PE people a lot of good confidence too.
For the leaders out there that have experienced this, you're probably getting the drips of sweat already about the PE executive report out or
Oh yeah,
boardroom.
board
When you have
packages.
when you when you have that data, it's a great week. It's going to be a great call or a great in person. When you don't have that data and you're scrambling, you know exactly what I'm talking about. So let's talk about the data room, right? So a lot of people don't know what a financial data room is. Michael, do you mind explaining what that is?
Yeah, so a lot of times the investment bankers will set it up and they'll control it, but at the end of the day, it's kind of where all the requests are lying, from us, from the lawyers, from the investment banking firm. All the data is being uploaded there. So this
Right.
is where we were saying earlier, where it's like another full-time job. So you already have all your stuff sitting someplace, wherever your internal documentation room is. So now you're starting to convert everything that you have internally and you're uploading it to the new platform that the investment banker is asking for.
Right.
This way, everybody has access to it. They can see what's going on. They can make change, edit, track. Somebody's got to kind of manage that. And usually there's logins for everybody involved
Right.
in the data room to kind of populate it and watch it.
Yeah, and so if you haven't seen what that looks like and maybe you're scratching your head or you want to learn more, I know Citrin Cooperman has a readily available checklist. I do something with my free CFO playbook for wellness and fitness owners, and that way you can start having these things prepared. And I'll give
Yeah.
you an example as recent as this morning, and it was actually bank relation type of thing where we're looking to raise some capital and we have a list of banks, and I always like to be prepared before we even decide who that list is and who we're going to reach out to and get in front of, or even walk into the office with to talk about money, whether it's a line of credit, SBA, or traditional route. And so I'm big on speed because I think a
Yeah.
lack of speed kills all deals.
Yeah.
And people, it's funny, you think it's the algorithm. In a lot of ways, especially with these local banks, what they want to know is just you're buttoned up, that you're organized, and that you are disciplined. You're an executive coming in with your financials teed up. And so literally within 10 minutes, they sent me the checklist in their email, a portal, as you're saying, Michael,
Yeah.
password protected, encrypted, boom. And I got a yes right away. It's like, oh, yep, this is good. We want to partner up with you. Now they're trying to pitch me, well, my client, to give money away. They're pitching us to give us 5 to 600K. And so this is why it's so important that you do these things like Michael's saying today versus when you have people knocking on your door, you're asking them to come in and either give you money or buy your business. It's going to be a long road if you're starting to build it then. And so the financial data room, this is a practical thing you can do over the weekend. Just start collecting these things. Obviously, find your checklist. Citrin Cooperman has some great stuff on their website and resources. AFP, Brian Lapidus on LinkedIn. Check him out. They have a ton of great resources, so much out there. Or reach out to me or Michael as well. But yeah, so the financial data room is huge. Do you ever what are the most common missing documents that you see delays the whole process?
It's the older stuff like early leases,
Mm-hmm.
signed operating agreement, missing franchise agreements. Multi-unit franchisees form a lot of entities, right?
Right.
So missing formation documents, AN documents, Secretary of State registration documents, like just annoying paperwork that is
Mm-hmm.
missing to validate the entity structure that was created. And those are hard to kind of get. You got to call the lawyers that did all the formations and try to get them off the state websites, especially if you're operating in multi-states, which a lot of the big fitness franchisees do. They're not just one state, they're multi-state operators. So there's a
Yeah.
lot of legal paperwork that needs to be looked at to validate the entity structure. If you're an S Corp, S
Mm-hmm.
elections, were those filed? Were they not filed? So things like that are a pain to get because they're usually older.
You just made me think of something as you're saying S Corp, and I'm thinking the C Corp and the corporate veil. And then I come up because of experience, but the good old intercompany, or some people call it intercompany, and correct
Sure.
me, I don't know which one it is, but the intercompany cash movement.
Yeah.
And that is one of the things, even if it done correctly, when I lift up the hood, I just red flag it because I have a story from back in the day. I'm like,
Yeah.
man, we did this so wrong. But what's your recommendation as some of these franchise systems or portfolios, they have multiple entities, typically a holding company and some
Yep.
others, maybe one for their brand fund or some other things. How would you recommend, especially with your CPA background? Because I'm still trying to make sure client by client that we're doing this accurately. And obviously there's also some tax strategy involved. You're doing it the right way, right? What is your recommendation or is it case by case when it comes to intercompany cash movement?
Well, we can do some like generalities. So like if
Sure.
you're still using QuickBooks, you kind of have two ways to do it. It's like, do I open up a QuickBooks file for every single location, or do I
Mm-hmm.
use the actual location feature that's
The
within
tag.
QuickBooks and tag it? The tagging people forget though, so
Yeah.
they don't tag it. They
So
don't know
sure.
what it is. I'll get
No
back to it
memo.
later. And that's,
Ask accountant.
yeah, ask account.
Accountant's not here anymore.
Yeah, it's so, when you have 3 or 4 entities, it's one thing, but when you're these big groups and you're on 50 entities, that gets a little confusing.
Yeah.
So maybe time to think about newer systems like a
Mm,
NetSuite or something like that. And now you're running all your locations in one login. Like you
yeah.
log into NetSuite, you have a separate account for each club or location that you have. And that's how you're doing all your postings. And when you run your report at the end of the month, you know what to limit and what's left over to go fix, as opposed to logging into 20 different QuickBook files. So you probably know it already if you're an operator, if it's getting annoying to
Mm-hmm.
run reports, to log in, get the data that you need. And you probably outgrew QuickBooks at that point.
Yeah. And they won't kill me for not bringing it up because they're not an official sponsor. They do not pay me and they give me the swag for free. I just am entertained by the battle of Rillet and NetSuite. I like to throw Rillet out there. They're a ton of fun. They got good attitude. And I'm also part of the CFO Leadership Council and
Oh,
Alliance Group, and NetSuite's involved in there too. And I'm just doing it out of love. It's always fun as I get to just watch it all happen. I love both tools. They're both amazing.
yeah.
So I'll bring that up. But no, I love that you said that around and clean books are also important too, right? And you talked a lot about that on the front end, specifically when you're talking about due diligence. And one of the things I always get asked this question a lot. Well, Albert, which one of my financial statements is the most important? Is it the P&L? Is it the balance sheet? Is it my statement of cash flows? What would be your answer to that? Because I have my answer, and you know what? I'll hold back. What would be your answer?
Well, most of the operators are using the P&L because
Right.
they're ignoring the balance sheet, which has debt repayments and, asset classes and things like that. If you're really like into real reporting and you're on the cycle, the cash flow statement, that is like, where is your money going? Like
Yeah.
that is a very important and very overlooked statement. Like, what is going on with this business? Where is the money going every month? Is it in owner distributions? Is it debt
Mm.
reservice? Where is it going? Are my payables building up? Are my receivables building up? Like, that shows you the change in all these accounts. And very quickly you can see, oh, I started with cash of this at the end of last year. Here's all the ups and downs, and here's my ending cash balance. So very important
Yeah.
statement. Balance sheet is always overlooked as franchisees are
It's
growing.
probably the most misunderstood, right? Or the one that's just not, you just don't get it. Like, what? I don't understand this whole asset and liability and each one of
Yeah,
those
yeah,
subcategories. It's so true. But I am a big fan of the three statement model. This is why I do it quite a lot, because it's not only good to model it out that way, but to educate using it. When you realize how they're all connected, it's actually pretty fun,
yeah.
because a lot of people know their income statement, their P&L, right?
Sure.
We're kind of all trained as business owners or those that operate in corporate America to understand your P&L. It's what many of us will be
That's
incentivized
where we
by, your
start.
variable comp. Yeah, your variable comp. But when you realize how that actually connects to your balance sheet or how it connects to your cash flow statement, it's actually a lot of fun to your point, to see how all of the money that you're generating or burning from your P&L, what it's doing to that bank account, or what it's doing to the value of your business. And some words or ratios that you want to look up is your liquidity. What does my liquidity look like? What does my solvency look like? So research some of those things too.
Yeah,
But Michael, I do want to come back to valuation, because we talked a lot about the FDD, royalties, the brand fund, or some call it the ad
sure.
fund, even reporting, right? And going down to those systems. But in the franchising world, where do you think there's still a lot of opportunity in some of those systems, whether it's royalty, brand fund, tech fund, FDD, that's actually still impacting, you're seeing it's impacting the valuation as of today for some of these businesses?
Yeah, we touched on a little bit earlier about franchisees needing to make money. If you require all these reports to come through, forget just the gross revenue reports so you can calculate the royalties and stuff. But if you're requiring all these other reports to come through, or for people to submit information monthly, and that's coming back in-house, what are you doing with that information? Do you have field consultants or business coaches that have blocks of franchisees that they can go out and educate those franchisees and say, look, we have all this data. You're in, the state of New York. Your payroll is 40% of your
Hmm.
revenue when everybody else in New York is at 25.
Mm,
What is going on with your location? How can we help you make more money?
yeah,
The strong brands there, that's what they're doing. And that's where the opportunity is in valuation, because it's all about the unit economics. And the PE people know this. Like,
right.
you can make sure that those franchisees are making money. The franchisor by default should do well. Maybe it's mismanaged for whatever reason, but they'll do what they need to do to fix that piece, because they know the franchisees are making money. And they're going to call the franchisees. Are you making money? Will you buy more?
Hmm.
I see you signed for 3, open 2. Are you doing the third? If you do the third, will you go to the fourth? Like, they're going to ask them these types
Hmm.
of questions, because they're the ones that validate the system. So
Sure.
that's, to me, where the opportunity always will be, is making those franchisees profitable, making sure we understand the unit economics, and making sure that they will validate the system for you. Because if P calls them all and they say, I don't know why I bought this, I will never buy another one, or whatever it is they're saying, like, I think you know what's going to happen next. There is no deal.
I love when I get some will joke at the call where you're asking a franchisee, save yourself from selling your soul in your house. Like, do not do this. Like, oh no, that's so bad. I love what you're talking around unit economics. I'm a big fan. I talk a lot about it, and it's an easy thing someone can do tonight. Hopefully you're not working late at night, right? But if you are, or tomorrow when you wait, open up your P&L and just do something as easy as every single line item. Let's just call them the expenses, right? It doesn't have to just be the big buckets, but the subcategories within those big buckets, like payroll or marketing. Divide it by your revenue, right? So you want a percentage of revenue, and just do it that way. It's going to be very eye-opening for some categories where you see your occupancy costs, right? Where is it? Is it 20%? Is it 30%? Is it 50%? Right? It's like, ooh, this is, and we're going to get into real estate here in a bit and occupancy costs. To Michael's point around payroll, it's not just about the percentage as it stands on your P&L, but to Michael's point, how is that comparatively to competitors or some of the data that you can get publicly, and do the same activity and see, is my payroll too hot? Are my occupancy costs too hot? Maybe that's something I need to renegotiate. Is my debt servicing too hot? And you can go line by line and just ask, how does this look? Is this healthy? Am I above trend? Am I below trend or comps? It's a really good activity to do to really see the health of how you're operating your business.
The franchisees, I mean, they should speak to each other. Like,
Absolutely.
I know there's franchisee councils and all the and
Committees, yeah.
co-ops and stuff that get put together. So, also at that level, talk to each other, see what's going on. Like, I'm not saying you have to give everybody your financial info, but you can get certain uh, metrics from your colleagues in the system, because if the brand grows, you're all going to do, like, the goal is that we're
Exactly.
all going to do well together. So let's help
Right.
each other succeed.
Well, I saw this a lot at Orange Theory. A lot of people who ended up selling off prior to the pandemic, or they were well off. They all were chatting with each other. And to your point, we're creating these committees
Yeah,
because they understood if the system as a whole is valuable, each one of our checks are going to be very large
that's
when
right.
we get to that exit strategy point. And so that was really exciting for them. And I know they're trying to continue to rebound since the pandemic. Sounds like they have a lot of momentum. So, real estate, you mentioned this earlier around leases. And this is something that I learned later on in my career around how important buyers in private equity and those that are investors think about leases. They go directly there. What are the terms remaining? What are the escalators? What are the
Yeah.
assignment clause? What's the triple net look like? Things like that. And what did you sign for so we know what's going on here? How have you found this to help certain valuation or even hurt some of it when you start to lift up the hood to financials?
Yeah, the leases are, especially for fitness brands, right? These are brick and mortar
Right.
locations. So really understanding, what you signed up for, the terms and all these things, it can go both ways. Are these favorable leases when they compare them to market rate,
Mm-hmm.
or did we sign a bunch of bad deals that these leases, like we can't make money on these locations because by the time we're done with the escalation
Mm,
clauses, it's going to eat up our profitability, or we don't have
yep.
the right to renew, or terms are only, 2 years, but our franchise agreement renewal is 10 years. Like,
Mm-hmm.
these things all kind of have to match up. So, like, when you're doing your planning, you don't want to just plan for, like, right now as a tenant. Like, what does it look like in renewal season, right? Because
Right.
your franchise agreement and your lease sort of may line up pretty close.
Sure.
Like, you sign a franchise agreement, you get open a year later, you sign the lease, you got 9 years left in the franchise agreement, 10 years left on the lease. So, like, how does that all play in with each other? Like, you got to kind of think about these, especially if you're an active multi-unit franchisee, you're going to be signing a lot of leases. So, like, you got to
Absolutely.
really got to understand these things and how they're all going to match up in the future.
It's so, and this is probably outside of cash flow. This is an area that I like to spend a lot of time just because of experience and going through the hard knocks of life myself and learning through this real estate or lease process before you even decide that you're going to pick a location. Or the other one where I see people get in a lot of trouble because you get so excited about location 3, 4, 5. You find it's like buying a home. You find the best home. It's like your dream one. It's your dream location. This is the new flagship, and you're willing to sign anything, and you realize that was a bad mistake. We didn't model for this. That's one of those examples where you see a 30% occupancy cost, and it's just with an escalator. So over time, it's actually
Yeah.
costing you more. So is your payroll, yet revenue is staying stagnant. That is not fun. That means your cash is slimming, your margins,
Yeah.
that back to that activity we're doing, your percentage of revenue that goes all the way down, flows through all the way down to your, let's call it your net operating income. It's not looking too hot anymore. It's slimming down. That is not a position you want to be in because it's very tough once you sign that deal, that lease to renegotiate. There's some landlords, they know. They have you, they have the leverage. That's not a great
Yeah.
position to be in.
Somebody mentioned something to me the other day that I thought was very smart. They were talking about the restrictions in a
Hmm.
lease. And so they said, well, what if you wanted to add certain food items to your lease? So, like, if you're a health and wellness brand, maybe you didn't start out a smoothie bar, but a year later, you want to add a smoothie bar. The franchisor says, we've tested this, we can add it. But what if your lease restricts that?
Right.
And now you're missing out on that,
Share of
on that
wallet.
revenue stream. So
Yeah.
these are all key things to kind of look at. And when the person told me, I was like, you know what, that's a really smart idea. I would have not have thought of
Mhm.
that.
And does Citrin Cooperman help with that, with some of this review, contract review, legal review?
Not too much on the leases. There
Okay.
are companies out there that will do the leases. We do have relationships with some of
Yeah.
them, so they'll run those types of analysis for you.
Excellent.
But yeah, like, we'll talk about it, but it's not like we're not doing that review or the legal side of it.
So I have a couple more questions because I want to respect your time. The one that keeps coming up, and I'd love to hear your perspective on this, is the working capital peg. There typically tends to be a stall there. Like, what the heck is that? And I had no idea this is something we are going to work through. Can you explain what that is as you're going through even like the Q of E process or due diligence process? What is the working capital peg?
The working capital is, a number that the buyer and seller are going to agree to with where the proceeds are being used, how much cash needs to be left
Right.
over in the business to operate it post transaction. And there's usually like a 60 to 90 day, post close adjustment period
Hmm.
to make sure that we have that number lined up. And then based on whatever that formula is in that calculation, there could be swings in purchase price or adjustments to the purchase price based on that calculation. I do not want to oversimplify it at all. And that's why there's such a long runway post close to make sure that those numbers are agreed to between the
Sure.
buyer and the seller. And that also goes into the QOV as well. There's a working capital adjustment component to it.
So it sounds like you're planting the flag, almost earmarking a use of funds, right? To make sure at some type of agreed upon ratio that these funds, and I'd imagine, especially if you're buying into or investing in a company, you just want to make sure the nuts and bolts, which is your work payroll, typically, not typically, is within your working capital piece. So you just want to make sure the core of the business is sound and we have runway for it. And you're not using this cash to go do something completely different that is taken away from keeping the core together, I'd imagine.
Keeping the business
So,
running. Yeah.
yeah, no, for sure. Exactly. Keeping the business running. Well, I have one more question for you. If
Sure.
you had just in this last minute, if you had the chance to just talk to all the franchisor, franchisee owners out there, even specifically in the wellness and fitness space, but it doesn't have to be, what would you say to them that just advice you'd give as you were mentored by Aaron, as you were mentioning it earlier for 20 plus years? What would you tell those that are up and coming, maybe that they want to invest or currently investing, maybe thinking of location 2, 3, 4? What should they be doing in 2026 and 2027?
Yeah. So franchising is so popular now as a business model, and there's so much private equity in franchising. It started with the franchisor, then it was the franchisee. Now it's suppliers, franchise suppliers, like marketing companies are being rolled
Hmm.
up into private equity platforms. So there's so much information that's out there. I know you can kind of go crazy too with everything you read, but there's like structured things, like start with the IFA and become part of the industry. Like, again, you don't want to become an accountant and you don't want to become this person. You are the operator of your business, but you can find easily readable information on your industry through these industry associations that are out there. Some of it's free, some of you have to be a member. So I get that part of it.
Hmm.
But the content's there, that they do educational webinars, the sessions are there, the roundtables are very good. There's panels at a lot of these that you can pick and choose what track you want to get educated on. Like, the information is there. So get immersed in it, get entrenched in it, follow podcasts like yours, follow other things that are out there, and kind of really learn what's going on as a whole. There's lots of legal things with
Yeah.
laws being passed in Washington, and we won't even talk about joint employer, but that was a thing for forever. And so there's all this stuff that goes on in franchising that it's very important to learn, especially at the franchisee side. Like when laws are being passed in Washington, members of Congress want to hear from the franchisees.
Hmm.
They want to hear, okay, how does your business impact the vote that you may make for me at the
Right.
local level? How are you employing people? Like, what are you doing in the community? If this law was passed, how would it impact your business as a franchisee? That's who they want to hear from. They want to hear from the local people on the ground. So there's lots of ways to get involved in the industry, both from a, educational point of view and really like just a good cause point of view to protect the franchise model that we all love.
So good. Actually, I want to give a shout out. Speaking of that, and going to Washington to speak on behalf of small business owners and franchisees. Rico from Strivewell, that is Sweat House and Strong Pilates. There, he did a fantastic job. So this is something recent. You can find his transcript online. Did an outstanding job representing all the franchisees out there on, to your point, Michael, employment and
Yep.
some of the specific laws and tax breaks and things like that. So it was really cool. Well, this has been so good. A lot have been wanting, and I think you brought it today, Michael, on behalf of Citrin Cooperman as well, just a playbook that we all can use as we're thinking about an exit strategy or just making our business more valuable, creating enterprise value. We went through what private equity is looking for and how you can be sellable, right? As you're thinking about potentially one day selling your business to make more, right? I don't think we all did this for it to be a hobby. We want to return on our investment. And so it's so important that you're thinking that way and that you're prepared, whether that means preparing for or getting and investing in a Q of E, partnering up with and hiring Citrin Cooperman to do something like that, or even taking advantage of their ecosystem as Michael had put it out there. And then also, how do you determine your valuation? How do you determine that multiple? And what are the drivers that support and strengthen? We talked a lot about that ramp pipeline. That's
Yep.
something to double click on and learn more about. And then that financial data room, that's one of my favorites, and just getting prepped today. And that's not just about even selling your business or capital raising, but it's also debt financing so that you get a yes when you go into the bank when they're asking you for these things. Some of you are familiar with, or maybe you're about to get familiar with the SBA loan process. That's grueling. There's a lot of paperwork, so
A
you
lot of
should get
paperwork.
that all ready today so that you're not, to your point, missing dinners with your family, because it's going to become a second time
Yeah.
full-time
Full-time job.
job. And that's one of those things. I see a lot of people actually quit the SBA process because it's so grueling, it's so lengthy, but it doesn't have to be. The underwriter can take it's their time, and obviously you don't want them to, but if you're going to put anyone's extra time on anyone, put it on them for a little bit, have your ducks in a row. So it's just easy. It's just easy. It gave you everything. Now you all go run your algorithms and figure out how we're going to mitigate risk. And then final thing that we chatted about is that FDD and item 7, item 19, transparency and compliance and governance controls in your financial
Yeah.
back office.
A
Michael,
lot to
this
do.
was a treat. Thank you. Yeah, there's a lot to,
There's a lot.
exactly. Well, for those that want to learn more about this, you mentioned some different areas, but I'd love for people to just reach out to you directly on LinkedIn. As you
Yeah.
mentioned, networking is so amazing. So
That's
don't
how
be
we
shy.
met, and here
Michael,
we are today.
that's right. Yeah. So how can people learn more about you and Citrin Cooperman?
Sure. Yeah. I mean, definitely, hit me up on LinkedIn, send me a message, or you can email me directly, MIANNUZZI at citrincooperman.com. I'll leave my cell as well. It's 516-445-8092. So feel free to hit up any of those numbers, email, LinkedIn, and I'll be at multiple conferences starting the end of February. So I'll be out and about for the next couple of months. So I'm sure I'll see many of you at some of these shows.
And Michael, that's bullish to throw your cell phone out there. I love that. So
Yep.
now I'm challenging everyone. Send him the funniest gift that you have, please. Text him, and that way
Please
he
do.
knows
Please
you
do.
heard you learned about him here on the Owner Seat podcast. And for those of you that are in the fitness and wellness space who want cash visibility, we chatted about some of these things today. Cash visibility or utilization modeling, pricing structure, capital planning, getting you ready for that exit strategy or some of that due diligence that Michael talked about today. Reach out to me at strategointel.com. But this has been such a pleasure, Michael. It's another episode of The Owner Seat. I'm Albert Ramos, your host as always. And remember, we drop episodes every Monday and Friday at 8 a.m. Central. Michael, thank you so much. Such a pleasure. So good. I'm so lucky to have you on, sir. Thank you.
Thank you. Thank you so much. Thank you for all your kind words. This is very good. Thank you.
My pleasure.